Many of you are comfortable seeing a steady number in your bank account, but that comfort is a dangerous illusion that ignores the most basic arithmetic of financial survival. If you have most of your money in cash, waiting for the perfect moment to invest, you're not being prudent. You're choosing a guaranteed loss of your purchasing power in the real world. Imagine inflation running at 3% annually while your bank pays you a paltry 0.5%. That means that every year you're 2.5% poorer in real terms of consumption. This isn't a possibility or an abstract statistical risk. It's a mathematical certainty that a high school student should understand, but that very intelligent people consistently ignore. In a decade, you'll have lost a quarter of what that money could originally buy, and that's assuming the official inflation figures are honest. The fundamental problem is that human beings are programmed to measure success in nominal dollars rather than real purchasing power, which is a catastrophic misjudgment. It's like celebrating that your car's speedometer is working while ignoring that you've run out of gas in the middle of the road to retirement. This cognitive distortion stems from the overreaction to deprivation. We hate losing what we already have far more than we enjoy gaining something new. That's why we cling to cash, terrified of market volatility, while inflation silently empties our pockets year after year like an invisible pickpocket. We're so scared of a temporary 20% drop in the stock market that we accept a guaranteed, permanent 30% loss in 10 years. To understand why cash is a trap, we must apply the principle of investing. Instead of asking what you should buy, ask what are the sure ways to lose. When you reverse the question about cash, the answer is obvious. Holding money in an inflationary environment is actively choosing financial decline for the sake of convenience. There is a concept in physics called entropy, where things naturally tend toward disorder unless external energy is added. The purchasing power of money has its own entropy and naturally decays unless you put it to work in productive assets that generate their own energy. It's compound interest working against you, a force that can be the engine of your wealth or the hammer of your downfall. People often confuse volatility with real risk. But true risk is the permanent loss of what your money can do for you in the market. A stock portfolio might fall 15% in a bad year, but history shows that it tends to recover and grow over time. In contrast, cash lost to devaluation never returns. It's a wound that doesn't heal and accumulates invisibly but relentlessly. Warren and I didn't build Berkshire by hoarding cash in a vault, but by acquiring productive businesses that can raise their prices and adapt. When we buy companies with pricing power, we buy protection against inflation, something cash in the bank simply can't provide. There are 5 fundamental assets that are safer than cash because they preserve and increase your real purchasing power over decades. The first is productive businesses, what we commonly call stocks, which represent partial ownership of machines that generate real value for society. A well-run company with a strong brand doesn't stand idly by when costs rise. It adjusts its prices and its profits grow along with the economy. If you own a large business, you own a piece of human ingenuity that adapts naturally to monetary crises. Historically, stocks have delivered a positive real return, while cash has returned negative figures after adjusting for the cost of living. However, owning businesses is only safe if you stay within your area of expertise and have a deep understanding of what you're buying. If you panic and sell when the market drops, or if you buy trendy companies you don't understand, then your actions make the stocks dangerous. Security lies not only in the asset itself, but also in the combination of the asset with the disciplined psychology of the investor who manages it. Most financial failures occur because people don't know their own limitations and operate under the influence of envy or fear. Know what you know and, more importantly, have the humility to acknowledge what you don't know to avoid preventable disasters. The second asset class that the wealthy prefer is productive real estate, properties that generate consistent rental income, not just speculative price increases. A property that produces cash flow tends to see its rent rise with inflation, while your mortgage remains fixed in nominal terms. In this scenario, you're paying your loans with dollars that are worth less each day, while the asset's value and yield grow. Warren Buffett and I have owned a lot of real estate, but always under the premise that it must serve a clear, productive purpose. If a property isn't generating money for you today, you're not investing. You're betting that some older fool will pay you more tomorrow. The third asset is the most overlooked: yourself, your skills, and your ability to generate future income through applied knowledge. Benjamin Franklin said that an investment in knowledge pays the best interest, and he was right, because your skills are the only asset that inflation cannot confiscate. If you invest in being someone who solves difficult problems, the market will always find a way to reward that utility generously. Your skills are portable. They cannot be wiped out by a stock market crash or devalued by a government decree on the national currency. But be careful. You must learn skills that the market truly values, not things that no one needs, so that your personal investment yields a real return. Throughout my life, I've dedicated myself to learning from multiple disciplines: law, mathematics, psychology, to cultivate a comprehensive mental toolbox. You can't build a robust financial life with a single limited perspective. You need to understand how the world's complex systems interact. Invest time in becoming a more rational and educated person, and you'll find that investment opportunities become much clearer and less risky. Your ability to build wealth is the present value of all your future income, and increasing it is the surest form of protection against uncertainty. Self-education is the superpower that allows you to navigate economic cycles that devastate those who stopped learning 20 years ago. The fourth asset class is high-quality bonds, but only in specific situations and as a tool for strategic flexibility, not for long-term accumulation. A bond is a promise of future payment, and the risk is that this payment will be worth much less in the future due to currency devaluation. If you buy long-term bonds with low yields, you are willingly accepting a loss of purchasing power in exchange for a false sense of security. However, holding short-term bonds allows you to keep your powder dry to take advantage of opportunities when others panic and sell assets at fire sale prices. Warren uses cash and cash equivalents as an opportunity reserve, not as a way to get rich quick. Many people make the mistake of treating bonds as universal safe havens, ignoring that the real return can be negative if it doesn't outpace inflation and taxes. If a bond doesn't pay you enough to compensate for the risk of devaluation, you're setting yourself up to lose money in slow motion while thinking you're being prudent. The golden rule is simple. If an asset doesn't preserve your purchasing power, it's not safe, no matter how guaranteed it may seem by an institution. Don't be seduced by the reassurance of a fixed payment if that fixed payment will buy you half as much in 10 years. Cash has liquidity, but bad bonds have the worst of both worlds: inflation risk and a lack of immediate flexibility. The fifth asset class consists of useful real assets, things that have intrinsic value because they fulfill a necessary human function, such as fertile farmland. This is very different from gold speculation, which simply sits idle, waiting for someone to pay more for it. A farm produces food year after year, generating real value that society demands regardless of the legal tender. Warren Buffett often says that you could have all the gold in the world and it would produce nothing, whereas with the same amount of money, you could buy all the farmland. Real assets have value because they perform a useful function, and their usefulness is the strongest foundation for long-term wealth preservation. The difference between the wealthy and everyone else is that the former seek active assets that work for them, while the latter settle for passive assets. Cash is passive by definition. It doesn't generate anything, it doesn't adapt, and it depreciates simply due to the passage of time and monetary policies. You must ask yourself if your strategy is based on the hope that the system will take care of you or on the reality of economic productivity. The question isn't whether you need some cash for emergencies, of course you do, but whether cash deserves to be the center of your financial life. Understanding why people prefer cash, despite the mathematical evidence against it, is crucial to avoiding falling into the same traps. One reason smart people make mediocre financial decisions is the social proof tendency. Everyone else is doing it, so it seems right. But following the crowd is the surest path to investment failure, since most people trade based on emotions, not analysis. In times of crisis, what seems safe to the masses is often what causes the most long-term damage to careless savers. Learn to think for yourself and evaluate assets based on their ability to generate value, not their popularity or family tradition. Mental independence is the rarest and most valuable asset in a market dominated by fear and constant imitation. Another trap is the availability tendency. The fear of a stock market crash is vivid because it's on the news, while inflation is a silent erosion. We fear the dramatic and ignore the persistent, leading us to protect ourselves from the wrong risks, while the real danger consumes us. You might see a 10% drop on your investment screen, but you don't physically feel your $100 bill buying less bread each month. That invisible loss is actually more dangerous because it's permanent, while market fluctuations are usually temporary for the patient investor. Your brain lies to you by prioritizing visible threats over the slow processes of capital destruction. The solution isn't to ignore your emotions, but to build rational systems that protect you from your own biological impulses of fear and greed. My system has always been to decide on a plan based on rational analysis and then stick to it regardless of the daily media noise. Financial success is the result of not being persistently stupid for decades rather than being incredibly brilliant for a few moments. Don't panic sell, don't chase absurd trends, and don't mistake frantic activity for real progress toward your life goals. Discipline is the bridge that connects your objectives with the tangible results you want to achieve for your future and your families. To apply this, first ask yourself what your true circle of competence is and what you actually understand about the economic world around you. If you don't understand individual businesses, perhaps your best option is a low-cost index fund that captures the overall growth of the economy. The second question is what your real risk is. Is it short-term volatility or reaching old age without sufficient purchasing power? For most, the real risk is future poverty caused by present inaction and a fear of investing in productive assets. Your time horizon determines your strategy. If you don't need the money soon, cash is logically the worst option available. Many people get stuck on the first order thinking cash is safe because the number doesn't change, but they ignore the second-order consequences. Second-order thinking reveals that excessive security today leads to a scarcity of options and a lack of freedom tomorrow. Reversing the situation brings clarity. If you keep everything in cash for 20 years, the most likely outcome is a massive loss of real wealth. If you can't accept that guaranteed poverty outcome, then you must be willing to accept the discomfort of current volatility. Write down your answers to these questions to force your brain to reason in a structured and logical way. The reason many people don't prosper isn't a lack of opportunity, but a lack of rationality and a tendency to act on emotional impulse. You can't get rich through positive thinking if your actions contradict the laws of arithmetic and the preservation of capital value. But you can avoid poverty by being rational enough not to make stupid mistakes repeatedly over the years. Warren and I aren't geniuses. We've simply decided to be patient, rational, and avoid doing foolish things with our accumulated wealth. Success is a game of endurance, where the winner is the one who makes the fewest mistakes and allows time to work in their favor. This approach is accessible to anyone willing to be honest with themselves and have the patience to let compound interest work its magic. You don't need insider information or extraordinary luck to build a solid financial foundation. You just need discipline and respect for the value of time. A prime example is the tech bubble of the 1990s, where everyone called us dinosaurs for not buying companies that weren't generating real profits. We stuck to our process, and when the bubble burst, we continued to grow while the geniuses lost everything they had gained. Being rational might seem boring and even stupid in the short term, but it's the only strategy that guarantees long-term survival. I'm not suggesting you put all your capital into the stock market and pray there won't be a crisis. That would also be a form of reckless imprudence. The golden rule is to maintain an emergency fund of 3 to 6 months' worth of your actual expenses in cash or highly liquid equivalents. That's your insurance against life's unexpected events, so you don't have to sell your earning investments at the worst possible moment out of necessity. But there's a world of difference between having 6 months' worth of emergency expenses and having 6 years' worth of income sitting idle, losing value. I've seen people with fortunes in cash out of fear of the unknown, when their real risk is the certainty of the devaluation they're experiencing every day. If you have more cash than you need for your emergency fund, that surplus should be working in assets that generate more value for you. Keeping excessive savings in the bank is essentially paying a very expensive subscription to inflation in exchange for a false sense of security. It's your responsibility to distinguish between the money you need for tomorrow and the capital you're building for your future self 20 years from now. Prudence is about managing real risks, not hiding from them while letting time erode your future purchasing power. Don't let fear of an unlikely event prevent you from preparing for the more likely one, that life will be more expensive tomorrow. You should be aware that the financial industry often gives you mediocre advice because its incentives are usually not aligned with your actual well-being. They make money from constant activity, commissions, and the fear that you need their active and expensive management. If an advisor told you to simply buy and hold quality assets, they would stop making money from you. That's why they prefer complexity. Learn to evaluate the incentives of those who advise you to know if they are truly looking out for your best interests or simply want a share of your capital. The best advice is often free and boring. Spend less than you earn and invest the difference with great patience. People look for magic tricks to get rich quick, but the real secret is that there is no secret, only discipline and respect for the laws of mathematics. The person who buys good assets at fair prices and holds them for decades will always beat the one who tries to predict the market's next move. History is relentless. Rationality and compound interest win the race, while frantic activity and excessive cunning end in burnout. Don't try to outsmart the market. Try to be more patient and disciplined than everyone else, because that is the greatest competitive advantage there is. Your greatest asset is not what you have today, but your ability to stay the course when others lose their heads. Consider the opportunity cost of every dollar you leave in cash today. It's not just a dollar, it's the loss of what that money would produce in 30 years. If you keep $100,000 in cash, in 3 decades you will have lost more than half of your real wealth due to accumulated inflation. In contrast, if that same money is invested in assets that yield 10%, it would become a sum that guarantees absolute freedom. The difference between poverty and comfort in old age is often the decision you make today about where to park your surplus capital. Don't let the false security of the present rob you of the freedom of the future. Look at the numbers honestly and act accordingly. Many are afraid to invest before a market crash, but history shows that if you have a long-term horizon, you always end up winning if the assets are high quality. Furthermore, you can use the dollar average cost to invest regularly, eliminating the problem of trying to guess the best time to enter. The most costly thing isn't investing at a bad time, but not investing at all while waiting for a perfect market that will never clearly deliver. The market may crash tomorrow, but it can also rise long before it crashes, and if you miss out, you'll have lost the protection that only real assets provide. Acting with a rational plan is infinitely better than waiting for a divine sign that never comes while your money evaporates. When you can't predict exact market outcomes, you must focus on making your decision-making process logical and consistent. A sound process applied consistently inevitably leads to satisfactory results, while luck is a very poor and dangerous financial strategy. Don't be like someone who gets lucky once and thinks they've discovered the wheel. True mastery comes from repeating rational actions. Financial security arises from understanding the rules of the game and playing by them, accepting minor volatility to avoid the major catastrophe of financial irrelevance. Be the master of your decisions, not a hostage to your basic impulses of fear or unbridled greed. Cash isn't the enemy per se, but treating it as your primary refuge is a mistake born from a psychology that clashes with monetary reality. The assets we've discussed are rational responses to a world where productivity is rewarded and paper money depreciates by design. Your task is to think for yourself, understand the principles, and honestly apply them to your own unique situation to protect your future. Turning the question around will save you a lot of headaches. Avoid going poor and don't volunteer to lose your wealth through sheer inaction. I've seen this pattern repeat itself for generations, and the conclusion is always the same. Rationality is the highest-paying asset in history. Warren and I didn't get here by being brilliant, but by being consistent and persistently avoiding stupid mistakes over 8 decades. You can do the same. You can build a life free from financial anxiety if you choose to be a little more rational today than you were yesterday. The world rewards long-term discipline, even though it sometimes seems to reward short-term folly. Stand firm on what you know to be logical. Don't keep all your money in the bank wondering why you're not prospering. Put your capital into the hands of human production and ingenuity. The future belongs to those who have the vision to look beyond immediate comfort and the courage to trust economic arithmetic. Finally, take out a pen and paper, analyze your actual numbers, and be brutally honest about the true cost of your current passive savings strategy. Create a logical plan that you can execute with military discipline, regardless of what the news or your neighbors might say tomorrow morning. Don't let fear derail your course or greed cloud your judgment. Simply execute with the cool head of someone who knows time is on their side. This is how you win, not with genius, but with the absence of stupidity, not with luck, but with patience and consistent exposure to productivity. The power to change your financial destiny is in your hands. It only requires that you decide once and for all to act with supreme rationality. Understand that the modern monetary system is designed for the value of money to depreciate, forcing people to become investors if they want to survive financially. If you ignore this fact, you're fighting against a rising tide that will eventually drown your savings if you don't build a solid foundation. Productive assets are that foundation, allowing you to ride inflation instead of being inevitably submerged by it over time. This isn't a matter of political opinion or personal preference. It's the very structure upon which the global capitalism we all live in is built. Accept reality as it is and adapt so that your hard work translates into wealth that truly stays with you until the end. Patience is your greatest ally, but also your toughest test, as the world will constantly push you to seek quick and exciting results that rarely come. Munger always said that most money is made by waiting, not trading, and that waiting requires a character forged in the conviction of your principles. Learn to enjoy the slow process of growth, watching as each asset you own adds a grain of sand to the mountain of your financial freedom. Haste is the enemy of wealth, as it leads you to take unnecessary risks and pay exorbitant prices for the promise of instant gratification. If you manage to master the art of rational waiting, you will have won half the battle against the economic mediocrity that traps most people. Consider that risk isn't just about losing money, but also about foregoing the income necessary to meet your future obligations and your dreams of complete independence. Inaction has an opportunity cost as real as a stock market loss, even if it doesn't sting quite the same way at the exact moment it happens. You must view your capital as an army of soldiers who must go out and work for you, not as a collection of relics to be kept in a display case. Every soldier who stays in the bank's barracks is a soldier who isn't capturing value on the battlefield of global production. Put your army to work intelligently, and you'll see victories accumulate over the decades in an almost miraculous way. Intellectual honesty is the virtue that allows you to correct course when you realize your previous strategy was flawed or based on erroneous premises. Don't cling to an idea just because it's yours. If cash is failing as a store of value, admit the error and move to where the value truly resides. Many investors go down with the ship out of pride, preferring to be right rather than have money, which is a tragic form of personal financial vanity. The ability to change your mind in the face of new evidence is what separates the wise from the foolish in the complex world of investing and saving. Cultivate an open mind, willing to be challenged by reality, and you'll be protected against the biases that cloud the judgment of the crowd. Diversification is the only free lunch in finance, but only if done with common sense and within areas you truly understand and can calmly monitor. Don't diversify simply for the sake of having a lot of things, but rather to reduce the impact of a single mistake without sacrificing the overall quality of your asset portfolio. Owning a little bit of everything you don't understand is a form of collective ignorance, while having a smart focus on high-quality assets is the path to excellence. Seek the balance that allows you to sleep soundly at night, but also gives you the necessary exposure to the economic growth that generates true wealth. Balance is a discipline that requires constant vigilance and fine-tuning as your life circumstances and the global environment change. Mental resilience is built by facing minor fluctuations with your eye on the end goal without letting the daily noise disrupt your financial rhythm. There will be times when it seems like the world is ending and all your investments are a mistake, but that's where character is tested and rewarded. Remember that crises are temporary, but the erosion of cash's purchasing power is a constant trend and much harder to reverse once it has occurred. Maintain a historical perspective and remember that humanity has always found ways to innovate and thrive, even after the darkest and most difficult periods. Your belief in human productivity is the foundation upon which your success as a long-term investor in real assets rests. The legacy you leave isn't measured solely in numbers, but in the wisdom you impart to those who come after you about how to manage capital with integrity and sound judgment. Teaching your children and grandchildren not to fear investing, but to respect and understand it, is a gift far more valuable than any direct or passive monetary inheritance. Financial education is the key to freedom for future generations, enabling them to navigate a world that will become increasingly complex and demanding in terms of resource management. Be an example of rationality and patience, and you will see how your influence endures far beyond your own physical existence on Earth. Wealth is a responsibility that must be managed with the benefit and well-being of society as a whole in mind. Never underestimate the power of positive momentum when you start making the right decisions consistently and see the first fruits of your new financial strategy. Once the investment wheel starts turning, it becomes easier to keep it moving and add more capital to a system you already know works. The hardest part is always the beginning. Breaking free from old passive saving habits and facing the initial fear of the unknown and market volatility. But once you cross that threshold of knowledge, the mental clarity you gain becomes a powerful engine that propels you forward with increasing force. Trust the initial process and don't let the first obstacles stop you, because the ultimate reward is the peace of mind that comes from knowing you're on the right track. Success requires a balance between the ambition to improve and the satisfaction with what you already have, preventing greed from clouding your ability to make prudent and ethical decisions. Don't chase every last penny of profit if the risk is compromising your integrity or your mental health, because no fortune can compensate for the loss of inner peace. Invest to live better. Don't live to invest obsessively, always keeping your human priorities above stock market or real estate returns. True wealth is the ability to say no to what you don't like and yes to what you truly value in this brief passage through life. If money takes away your freedom instead of giving it to you, then you have failed in the execution of the most important plan of all. Having an internal compass based on unwavering principles will protect you from fleeting fads and the advice of those who only seek their own immediate gain. Munger always said that if you know you're right because your facts and reasoning are sound, you don't have to worry about what the rest of the world says. External validation is a dangerous drug that leads you to buy high out of euphoria and sell low out of fear of social disapproval from your inner circle. Learn to trust your own analysis and stand by your conclusions, even when it makes you seem like a freak or a dinosaur in the eyes of others. The solitude of the rational investor is often the prelude to an abundance that others can't even imagine in their wildest dreams. Time management is just as important as money management, since time is the only resource you can't get back, no matter how much your real estate investment account grows. Don't waste your life chasing every market fluctuation. Build a system that works on its own so you can dedicate yourself to what truly matters: your family, your health, and your passions. Productive assets are there to serve you, giving you the time you need to enjoy life without the constant pressure of directly exchanging hours for money. Time freedom is the highest dividend any investment can pay, and it's the ultimate goal of anyone who aspires to true worldly wisdom. Value every minute of your existence and don't let financial anxiety steal the joy of living fully and consciously in the present. Always maintain a reserve of humility to recognize that the world is unpredictable and that even the best-laid plans can face challenges you hadn't originally anticipated. Humility allows you to adjust your sails before a storm and learn from mistakes without your ego getting in the way of necessary and urgent corrections. Don't think of yourself as a genius when things are going well, nor as a failure when they're going badly. Simply be a diligent student of reality who never stops learning. Overconfidence has been the cause of more downfalls than a lack of pure intelligence, so always stay alert and grounded. True mastery lies in knowing that there is always something new to learn and that the market has a unique way of humbling the arrogant. Ultimately, investing is an act of faith in the future and in humanity's capacity to solve problems, innovate, and create a better world through collective effort. By purchasing productive assets, you are betting on progress and participating in the growth of civilization in a way that is direct and meaningful to everyone. Cash is a bet on paralysis and fear, while investing is a bet on life and the constant development of our human capabilities. Always choose the side of building and utility, and you will find that the financial universe tends to reward that attitude with surprising and lasting generosity. Your journey toward financial excellence is also a journey toward a better understanding of yourself and your role in the grand scheme of things. End this reflective process with a smile, knowing that you now possess the clarity needed to take control of your financial future with a confidence you previously lacked. There is no greater satisfaction than acting with full awareness and seeing your logical decisions transform into real and tangible results over time. Go ahead, put what you've learned into practice, diversify your assets, invest in your skills, and let compound interest be the wind at your back. Success is not an accident. It is the inevitable consequence of a life lived with reason, patience, and integrity every step of the way. May the wisdom of the great masters guide you, and may your own discipline be the engine that propels you to the goal of complete independence.